So this is one that was suggested by a listener that, or a viewer, depending, because we're on video and on audio, but however they were consuming us, suggested that we should cover the Icelandic banking crisis after the global financial crisis. So in 2008, basically the Icelandic banking system collapsed completely. This hasn't happened anywhere before. There's basically, or there were, three major banks and retail banks, and they couldn't refinance the massive short-term foreign debt that they had, and so there was a good old-fashioned bank run, and the government was forced to step in and create new banks. They basically started afresh, focused on domestic operations. The problem that they got themselves into, Steve, from what I understand, they had very high interest rates. And so everyone was saying, well, fantastic. It's introduced the whole carry trade scenario where people said, well, okay, let's put money into Icelandic banks because they are giving such a good return. So why would we put it into a European bank? So you had a lot of foreign deposits going into these banks, completely out of kilter with the GDP of the country. Many times the GDP of the country was assets that were sitting in banks. And so, I mean, it was destined to fail, wasn't it, on that basis?
Well, this is one of the things which Keynes commented, which my old friend Fred Andresen found, and I still haven't been able to locate the quote myself, but he insists it's there. Keynes said it when he was trying to design a post-war financial system, and above all else, let finance be national. Well, Iceland is a complete contradiction of that, and it meant that it was... They got caught up in a Ponzi scheme about I think it was the price of letting housing. It's ridiculous to imagine that a country went from, and looking at the data now, its total debt went from 350% of, financial corporations. So just the companies that are part of the financial sector, banks, NBFIs, if they existed. It's only a very small country. 300,000 people.
I think it was largely these three big banks.
It went from about 300% of GDP to 1,000% of GDP between 2003 and 2009. So just beginning at a level which is ludicrous and going into what you might, for want of a better word, called plaid, where the debt level becomes ludicrously high, and then total collapse was absolutely certain. You had all these depositors who were not domestic depositors who would have been wiped out if the bank failed. So the government said, "Oh, we'll cover the losses," and then the Icelandic people said, "No, you won't." I think that's the most fascinating thing about it. Politics.
Yeah, so they didn't. Yeah, whereas everywhere else in the world the banks were bailed out, here they weren't because it was so much foreign debt.
It wasn't just that; it was the actions of the Icelanders themselves. I mean, this is when the crash occurred, like virtually every other banking system in the world, the focus of the authorities was on saving the banking system, and not saving the economy itself. So, like in America, Obama signed a bill to relieve mortgage players of their mortgages, and basically a debt jubilee of sorts. Virtually nobody got that money, but at the same time they put out the TARP plan, which gave $700 billion to a number of. Ultimately, it was measured in the trillions, the amount of money that the government transferred to the finance sector to stop the finance sector crashing, and then the same sort of thing was agreed to in Iceland, and partly because Iceland is so small. Something of the order of 50% of the population surrounded the parliament and were demonstrating against it, the clanging of domestic items and so on. And I don't know the political structure correctly, but there was like a prime minister and a president, and the prime minister had signed this thing off, and the president was supposed to authorise it, and he said, "No, I'm not signing it," and then that forced the entire reverse of the reconciliations, where the banking sector was shut down, and the foreign depositors were, you're on your own, and that
money's gone, basically.
Yeah.
So and it was like a secular argument, because the interest rates in the UK at the time were about 4.5%, and in Iceland they were 18%.
Yeah.
So everyone was going, well, great, let's just put our money into Iceland and get that 18% from depositing in Icelandic banks. And the reason the interest rate was so high was because the central bank there was saying, oh, the economy is running so hot, so we better put better interest rates. But the only reason it was running so hot was because everyone was putting money there because the interest rate was so good.
This is one thing,
and so it goes on.
This is one thing I find funny when I listen to Austrians talk about how they think we shouldn't have any regulations at all. Just let the banking sector work it out, because if you have banks, which I've literally seen. I think this is in Hayek. I know it's in Rothbard and comments other Austrians like this. People will not sign up to a bank offering outrageous interest rates because they'll know that that's something suspicious, and because they know it's suspicious, they won't take advantage of the high rates. Well, I'm sorry, I give you Iceland, and I give you English people investing in putting deposits in Ireland. So that you offer people a high return, they run for it. The whole idea that they've got this, Austrian mental system inside their brain that lets them know this is unsustainable, therefore they won't do it, goes out the window. And another. Yeah,
I suspect they won't do it again, though. I mean, maybe there's a lesson learned here.
Give it another 10. I mean, this is the people. I once gave a presentation on my Minsky model when I got my position at the University of Western Sydney, and I jumped from being a tutor to a senior lecturer. I jumped over the lecturer stage in that promotion, in that job application, and they asked me to give the reason was my work on Minsky, fundamentally, and I gave a presentation on my Minsky model of Minsky's financial instability hypothesis. And there was a very lovely, but a completely lovely bloke, but in terms of intellectual contribution, mediocre. He walked out of the room with me and said, Steve, the difference between me and you is that I believe people learn from their mistakes. And I said, yes, Andrew, and the other difference between you and you is I believe people forget and die. And that's what's happened. You see, so rapidly people fall back into the old patterns. And it's not just the average person who does it. The bloody economists do it as well. So I'm now seeing stuff on Twitter where these neoclassicals are saying how great their techniques are and how lousy the approach of heterodox economists is, completely forgetting that they didn't see the financial crisis coming just 20 years ago. And there are young kids coming up who don't even know what happened.
Yeah, and won't know anything about what happened in Iceland. But it all seems so extreme, doesn't it? So the amount of money sitting as assets in those big three banks in Iceland, three big banks for a country that size is a bit curious in the first place. But the assets were worth about 11 times Iceland's GDP.
Yeah. The same thing,
and no one picked it up and thought, well, that might be a problem.
Yeah, I know. And this is one of the problems which are the legitimate criticism of thinking you can regulate the private sector effectively, and that's one criticism Austrians make and say you can't. Well, this is a case where you show you can't, unless you have guidelines based on that particular issue. Then you don't get any. The regulation won't even exist. And again, this is something which I've seen with people looking at data like that and saying, "Oh yeah, their debts are very high, but look at their assets." Okay. Now they don't see there's a link between the debt and the assets that causes that level of overvaluation. So when you suddenly can't service that debt, then the debt gets unpaid and the asset prices plunge. And that was the phenomenon of the global financial crisis in general.
And Icelanders were borrowing money in foreign currencies. This is how the carry trade works, isn't it? They go, well, okay, let's borrow money. Let's borrow the British pound. Because it's cheaper to borrow than it is to borrow the Icelandic currency. Yeah. So let's buy the British pound and then convert it back to, use that money to invest in the Icelandic bank. So you have the carry trade, which is where all this foreign money starts coming in. So a massive amount of money going in and out of the country. And I think part of the problem was that the krona lost its value in this process when it was all starting to come unwound. And maybe this is why people circulated around Parliament, because krona basically lost half its value. Yeah. So short-term financing became more expensive, but more to the point, the cost of imports for a country that size all of a sudden doubled. Yeah. So the people's cost of living just went crazy.
Also, the way they'd set themselves up, they were setting up themselves for a neoclassical catastrophe, because one point Bernanke makes in his essays on the Great Depression is one of the problems with private debt and with inflation is that when you borrow money, it's not linked to the rate of inflation. So you've got nominal debts and then a real economy, and that can cause an imbalance. So he recommended that your debt becomes inflation indexed, and the only country in the world to do that was Iceland. So as the inflation rate went up, so did your debt.
Oh, right.
Okay, now that was taking the advice of a neoclassical economist on banking when they think banking doesn't matter in the economy. Welcome to the real world, everybody. So that was one reason why the debts exploded as well. The inflation rate was with inflation indexed debt, as the inflation went up, so did your debt.
Right. Plus the fact the currency was falling.
Plus the currency falling,
and that would have created an awful lot of inflation. And normally a central bank would try and prop up a falling currency. They'd buy up that currency or try and push up the interest rate to attract foreign investors.
But it was already, that's what caused the problem. Yeah.
It was already way high. And so foreign investors weren't interested. And the problem was, it was too big for the central banks to fix. They couldn't buy up those currencies to try and fix the problem, which is why basically the only way out of it all was to say, just let it collapse. I don't think that's ever happened anywhere in the world, has it? Basically, the whole financial system collapsed and they started again.
Yeah. There have been issues of that nature. I think Ireland had a period where that occurred, where the payment system broke down, and they ended up producing local currencies for a while to keep the system running. But in terms of a complete collapse of a financial system, yes, Iceland holds the record there.
So, I mean, surely the problem would have been resolved, and I guess I'm assuming they're doing this now, but as you say, things get forgotten about. Would just be to say, well, actually, there has to be a limit on the amount of foreign investments that are sitting in our bank account. They're just sitting in the bank account. I mean, if it's just there and it's not going into the real economy, I don't know how you regulate that. But surely there's got to be a stipulation to try and control that, because that's really out of kilter with the size of the economy.
Totally, and this is again a result of neoclassical obsessions about free markets and lack of regulation. So when those proposals, that's anti-free trade, or that's anti-competitive to have limits like that. So you just can't get realistic regulations in when you've got an economic ideology that virtually everybody shares, especially the politicians, that says, deregulation is what makes capitalism work well.
But the good thing was they did show the risk factor. So everywhere else, when we've seen banks collapse, there's not really been an enormous amount of hurt by people holding their accounts, has there? I mean, Cyprus took a slice out of everyone's bank account, didn't they? That would have hurt. But most other places, the government stepped in to try and protect people's money. And so that's not going to create rational behavior by banks. That'll just reinforce more risky behavior.
This is the whole era we're in is the era of the Greenspan put, because you have and again, this is something I'm sure most people have forgotten this. The biggest stock market crash in history occurred in October 1987, not October 1929, and not 2007, but 1987, and that was the first big financial bubble, really big financial bubble. There's one before a decade earlier, 1974, but the 1980s was extreme, and literally like in terms of the Australian market, which I knew very well at the time, because that's where I was living, the ASX increased by about 80% over 1 year. Okay? Huge increase in the stock market valuation. And in the background of that, you had superannuation firms people's money being put aside for taken out of their paychecks, put into what's supposed to be a long-term pension for them, and then invested by those firms in assets to get a return. And when they started out, they were putting 30% of the money into the stock market. By October 87, they were putting 70% of their money into the stock market. And because extra money to the stock market doesn't create more shares, it doesn't make much change to the volume, but it whacks up the price. You had this enormous increase in the value of the ASX, Australian Stock Exchange Index. Not quite so extreme in America, funnily enough, because when the crash occurred in October of 1987, the American market the S&P 500 fell 20% in one day, and the Australian market fell 25% on the adjusting for the calendar the same day. So the scale at which you can get overvaluation and crashes is just enormous. But the mainstream ideology says, laissez-faire is the best possible system. Now,
and yet it doesn't really impact the operating value of the company that's operating beneath those shares. So for example, a friend of mine works for Microsoft who had a 12 or more 14% fall this week because they gave their earnings results, and it was believed that the extra unexpected investment in AI was out of kilter with the revenue that was being received from AI. So, this big fear that maybe there's an AI bubble.
No.
But the fact that
couldn't be.
No. Can't imagine that. But the fact that the share price of Microsoft has gone down by 12%, it doesn't affect Microsoft in any way, does it? Really, it's just speculation that's driving those figures.
And what we have is a speculative system rather than a productive system. And you can see that in the growth of the financial sector as a share of most economies globally, and that's risen from something of the order of, say, 5 to 10% at the end of World War II to 20% and above over time, and that is unproductive. If the finance was causing the innovations in finance caused innovations in the physical economy, then we could keep the two in sync. But what those innovations in finance only causes asset price bubbles, and that's what we saw. The increase in house prices in the 2000s in the subprime period, which was a global phenomenon, was the Americans. It's known after the Americans because they had the most ludicrous legal dodges to get around. The fact that people have been lent money who shouldn't be lent money at all. But it was a global thing nonetheless. And Iceland was part of that, amplified by two things, that it took in depositors in foreign currency, the high interest rate thing you said as well, and the fact that their debts were inflation indexed, so the debts rose as the inflation rate rose.
Well, let's look at what they learned from that and what we could learn from it as well when we come back, as we look at the, is there anything we can learn from that Icelandic crisis, which took a lot of foreign investors, made them heavily out of pocket. We'll look at that when we come back in just a second. So the banks collapsed because of the debt. The currency halved in value. Inflation as a result of that skyrocketed. And as you say, also because of the index-linked debt. Iceland was in a bad way, and after people circled the government, they decided that the banks would not absorb the losses from foreigners. If you had money that basically wasn't there anymore, you didn't get any sort of compensation. Which actually is fantastic for Iceland, because they can just wipe the slate clean and start again, and the foreigners haven't got a leg to stand on. Their fault for taking advantage of what was clearly an unrealistic situation.
Yeah, and that's what happened. And the result was that Iceland suffered less than most other economies because the burden was felt by the financial sector and by people in other countries rather than by domestic Icelanders. So, in fact, they were criticised to high heaven about doing it, but the result was, I think, Iceland recovered much more rapidly than most other countries by breaching what the conventional economists said was the right thing to do.
Yeah, well, when you look at what, for example, Britain nationalised a load of banks and held on to them for a long time, and then the government sold them again, having lost quite a bit of money in the process, and it's only government money, so who cares? But it was, for example, the Royal Bank of Scotland got, its value is considerably less than was paid for when the government bought it up. So they didn't go through that whole process. They just said, well, okay, we'll just start new banks afresh. Yeah. No need to go through this rather laborious process of renationalising banks. Let's start afresh. And they obviously put in regulations. So number one, clearly, would be, well, tell you what, let's control how much foreign money sits in our bank accounts, but also how much Icelandic money leaves the country as well. Let's keep a control on all of that. Capital controls, yeah. And common sense, isn't it? And then also, I mean, the krona had been devalued by 50%, but actually that turned out to be quite a good thing, because their exports became a bit cheaper, and one of those exports was tourism. So I guess everyone came to see what a country that's just had a banking collapse looks like, and so they did quite well on tourism. Still are, apparently.
Well, they certainly have a feature that most countries don't have, and that's live volcanoes you can go and watch take off at various times. And that's the thing. It's on the split between two tectonic plates, and it's one of the most active volcano regions on the planet. So they had an attraction which you could watch the financial system burn down, and you can watch the volcanoes blow up at the same time. Great double.
But also, I mean, the advantage for them was because all this foreign debt overseas had just disappeared, they didn't have to go through a whole period of fiscal austerity.
That's right. They avoided austerity. Like austerity was what was imposed on England by the Tories after the financial crisis, in the belief they were saving for a rainy day. What they were doing was driving the non-government sector into even more negative equity than it already acquired out of the whole bust of the financial crisis. So Iceland, by doing the opposite of what mainstream economics advisors, came out of the financial crisis better than most other countries.
So let the banks fail.
Let the banks cover the losses and not the private sector. Keep the money in existence. They reduced the deposits of foreigners, but they kept the local domestic investments alive. You don't write off the finances of the non-bank system to keep the banks alive. You shut the banks down and start over again. I believe some of the banks had a vacation, didn't they? After the a fairly lengthy vacation, post the. In other words, they went to jail.
Yeah.
They had a large number of bankers in jail, and one of the people I've met through my travels is there's Bill White and Bill Black, two of the most important people at the time of the financial crisis. If we'd followed their advice, we'd be a damn sight better. Bill White was the research director of the Bank of International Settlements and saw the financial crisis coming because he understood Minsky. And Bill Black was the regulator who, prosecuted the bankers during the not the subprime crisis, but the savings and loans crisis at the time of Reagan. So Reagan deregulated the savings and loans, which used to be mutuals or building society type enterprises. Let all the sharks in the country buy them. There was a huge bubble and bust. I've forgotten the date of this thing. It's amazing how even I forget when a crisis occurred. Now I specialise in what causes crises. But in the aftermath of the subprime bill, put about 300 people, I think he said, behind bars. So even though at the time it looked big, it was nothing compared to what came later with the subprime crash in 2007. And the total number of people who went to jail specifically for the subprime was 0. When you look at the number who went to jail in total, it was 1, and that was Bernie Madoff. And you couldn't not jail Bernie Madoff. But so the extent to which bankers were prosecuted for what they did was zilch in the rest of the world. It was you're all in bloody jail and don't ever do it again in Iceland. So to some extent, Iceland is going to have a longer memory of what happened in 2007, and hopefully won't fall back in. But I don't have any faith. I think they'll forget and do the same thing again.
So, and of course, there was the difference as well in places like Ireland, where they took in a lot of foreign money as well, because there was an enormous amount of speculation, because the Irish economy was doing very well. So everyone thought, let's put money into
Celtic
Irish
Tiger,
real
they
estate.
used to call it, yeah.
Yeah, so there's this big bubble, and it's only because they were sort of like, everyone was using Ireland to try and evade tax, international taxes. So anyway, Ireland was doing very well, so people were putting money into their real estate, so lots of foreign money was coming into the banks. That money was being invested in assets which were going up in value. And then when those assets collapsed in value, the banks basically didn't have the equity. They didn't have the assets in value, so they had a debt crisis, and the government had to, because they couldn't just write it off because it was physical assets. The government did have to step in that situation, but also I think in Iceland they were helped by the fact that the currency did devalue so far, which at the time seemed bad, but in the end has actually turned out quite good for them. obviously in Ireland they can't do that because Ireland's in the EU, and
therefore they lost the exchange
there's
rate mechanism, which is a huge part of the problems with the euro. It's something that applies inside the country itself, or inside the eurozone itself. So if Germany is running a trade surplus with Italy, then money created in Italy gets transferred to Germany. And if anybody says, MMT says he doesn't know what he's talking about, I've done the model on that. That's what literally happens easily in the euro system. So you can't make an exchange rate change, and that normally means that Italian manufacturing suffers against German because of it. But in this case, you have a financial crisis with lots of foreign money involved. It'd be easier if you could devalue your currency, but you can't because it's not your currency. So Ireland suffered with it in the financial crisis. It suffered doubly out of that.
In the same way that obviously Greece has suffered with the debt crisis as well.
One thing, this whole thing, I mean, Iceland was pretty much the poster child of conventional thought, indexing your debt to the rate of inflation. So that's supposed to mean the financial sector doesn't lose when there's a high level of inflation, because when you have inflation, this is Bernanke making this argument, quite a few neoclassicals as well, that debt should be inflation indexed, and that way inflation doesn't penalise the lender. Okay? Because the inflation occurs normally, if there's a 20% rate of inflation and you've got debt which is nominal, then the financier loses 20%. So the idea is don't let that happen and we'll get a better system. What it led to is financiers lending like bloody crazy, and that huge overvaluation of Icelandic assets in general, and people turning up to take advantage of the high interest rate, and then a complete crash because people when you have inflation indexed debt, the banks are okay, but the borrowers are screwed. And so that was part of the reason, again, think why the Icelandic community was able to organise and politically process, we're not going to accept this. And it became obvious that if I'm saying President and Prime Minister, I hope I've got the terminology right, having the act being passed to repay the foreign depositors, and then put Iceland in usury for decades in trying to pay its way out in foreign currency of that debt, the president refusing to sign it because he could hear half the population around him smashing pots and pans and basically don't do it. And he didn't do it.
It was just too big. I mean, as I said, it was 11 times GDP with the assets sitting in banks.
But they were going to pay. They were going to sign off on it before the people protested.
Yeah, well, not surprising they did. So what can we learn from this? I mean, on one side, the mistakes made in terms of not having the capital controls for this to all get so out of kilter. But doesn't it also say, and I don't have the same view as you about the euro in that I feel like there's a need for, as we talked about a couple of weeks ago, a need for the United States of Europe. There needs to be a unified currency for Europe to help counter the strength of the United States. But this is pointing to the fact of saying, well, actually, no, a sovereign currency is almost essential in circumstances like this.
Yeah. When you have some,
it would be. They find it very hard. They would be still going down that road of austerity
if they had been taken on the
euro.
Yeah, they couldn't have. The devaluation wouldn't have occurred. So the idea. I mean, capitalism is the most creative social system in history in terms of the rate of technological innovation that it generates. So that's the positive for capitalism. But when people then think in terms of regulation, they end up deregulating not the industrial sector, but the financial sector. And then what you get is the finance sector expanding like crazy because it doesn't have the physical constraints of having to make goods and services. It's making contracts instead. And then those contracts can drive up the price of financial assets, and it looks absolutely hunky-dory to everybody. Everybody piles in, but it can only be kept on going so long as people continue servicing that increase in asset prices out of increase in income from selling goods and services. That is hiding to nothing to fail, and then you have a crash. And this lesson keeps on being learnt and keeps on being forgotten. So if you look back in the 1920s, that's what led to the Glass-Steagall Act. That did several things. It meant margin debt, which was money borrowed to buy shares, went from allowing a leverage factor of 10 to a leverage factor of 2. So and that's still in existence. It banned banks from owning shares. because one reason that 1929 was so devastating was when share prices fell 10% in one day. The shares were a large part of the asset backing of the banks. So the banks rapidly went from being in positive financial equity, which they have to be in, to negative, and bang, they're gone. That's the bank failures that led to. So we end up deregulating not the physical economy, but the financial economy. And then this leads to these booms and busts, and we keep on going back and making the same mistake. Because Bill Clinton, and I'm going to be meeting Bill Clinton in a couple of weeks' time, by the way, the thing called the World Economic Forum, which is taking place in Berlin in a couple of weeks' time. Apparently he and Hillary are opening the conference.
Are you talking there?
Yes. Yeah.
Oh, wow.
Yeah. But he was very proud of himself when he signed the act that effectively abolished Glass-Steagall. Okay, and then bang, we go back and do the same thing again. And now you see the British government talking about the same thing. Let's liberate the financial sector. No, let's keep it inside a bloody box. Thanks very much.
Yeah. And Iceland is a very good example of that, isn't it, really? So, and now, the economy is growing reasonably fast. It's tourism and fish, not banking now, which is driving the growth, which is perhaps what it should always be. There's some investment now happening in IT infrastructure and fishing vessels and tourism. But the IT is an interesting one because it's quite cold there, of course. So it's perfect for data centers. So perhaps they're going to be owned by Donald Trump fairly soon. But, interest rates are still relatively high there because I guess I don't know whether that's a factor of being a small economy. But it seems to be working. It seems to have found the right level of balance.
It's come out of it successfully, that's true, which you can't say of Greece. And in that sense, Greece is much larger, obviously, than Iceland in population and area. But it's by being part of the euro, Greece got screwed. And by being part of the euro, Iceland could say, well, screw you instead. So the English depositors lost out. Yeah.
Yeah. Well, serves them right is all I can say. Well, I mean, it's just risk, isn't it?
It is.
If you de-risk, if governments de-risk risk, then people will just keep
on. But it's also
more.
The fault of politicians thinking they're doing the right thing by deregulating the finance sector. Now, this is normal. Now, I'm a critic of Adam Smith. Okay, I'm going to praise him here because. People would, if I can be quite sure, many people who told we need controls on finance, we need capital controls, we need maximum rates of interest. Look, Adam Smith told us that the invisible hand is what manages a capitalist economy properly. No, you're going against Smith. No, you're not. You're following Smith. So this is a quote from Smith. It's in The Wealth of Nations. The legal rate, so he's talking about a rate set by law about the maximum rate of interest, ought to be not much above the lowest market rate. If the legal rate was fixed at 8 or 10%, so it's much higher rates back in those days, the greater part of the money which would be lent to prodigals and projectors, who alone would be willing to give this high interest. A great part of the capital of the country would thus be kept out of the hands which were most likely to make a profitable and advantageous use of it, and thrown into those who are most likely to waste and destroy it. So he was in favour of interest rate controls. Now, the people think that when they say...
Basically, he was saying it's all going into the financial sector and not doing any good.
Now, the people think that when they say that sort of stuff, they're following Smith. No, they're not. The guy they're following is Jeremy Bentham. And Jeremy Bentham really was the father of utilitarian economics, which he's a lawyer, but his ideas were really what neoclassical economics was based upon. And he wrote a paper called In Defence of Usury, in reply to Smith, and said, no man of ripe years and of sound mind, acting freely and with his eyes open, ought to be hindered, with a view to his advantage, from making such bargain in the way of obtaining money as he thinks fit. This proposition, were it to be received, would level all the barriers which law, either statute or common, have in their united wisdom set up against the crying sin of usury. So
and that is fine.
It's bullshit.
Put your money, put your money where you want it. If you think it's it's a good bet, but if it collapses, don't come expecting anyone to bail you out.
That's what they do. They follow Bentham and say no controls whatsoever, and it all goes bad.
Pear-shaped, and then they want to go and bail out.
Forget ideology at that point. If you're facing bankruptcy and you're a banker and you've still got the ear of a politician, you're going to say, rescue my assets and forget about my liabilities.
Yeah. Okay, well, we should look to Iceland who just basically said, yep, let's just close it all down and start again. So that's our lesson for today. All right, interesting stuff. It's good to look back in history sometimes, isn't it? We'll catch you again soon.
Remembering things, shouldn't do that. Oh, God.
No. Yeah. Oh, well, on this podcast, maybe we will. See you next week.